Hi, good morning, everyone. My name is Mobolaji Adebayo. I'm an analyst at TechCabal Insights. It's nice to welcome everyone. I should have added Happy New Year before my introduction, but it's fine. It's already February. It's nice to be here again to talk about the state of Africa, state of Africa's tech ecosystem. TC Live is an event series that's conceptualized by TechCabal, and today we'll be delving into the state of tech in Africa, which is basically um, a bird's eye view of major events in Africa's tech ecosystem. Think about funding, acquisitions, expansions, layoffs, shutdowns. And one thing we like to do every quarter or every time we release this report is to speak to stakeholders because we have the data and we could make our insights or we could make our informed hypothesis from the data. But speaking to investors and founders who have skin in the game in the ecosystem sometimes help us get a richer perspective on these issues and these data points. And TechCabal covers the business and human impact of technology in Africa through events like this, reports, news articles. We also publish the TC Daily, which is a comprehensive roundup of tech activities and events across Africa. If you're not subscribed to the newsletter, my colleague Victoria is going to drop a link in the chat box. I wish she has done that. And again, this event is organized by TechCabal Insights. TechCabal Insights is a research, analytics, and intelligence arm of TechCabal. It's a digital economic consultancy that helps startups, big tech organizations, government agencies make sense of Africa's digital economy and implement key interventions. Today with me, we have Matt Davies, who is the co-CEO and managing partner at Renew Capital. We also have Rosemond Phil-Othihiwa. I hope I pronounced the name correctly. Who is a corporate commercial and startup attorney. This event is going to be moderated by Maru, but just before he steps in, I would take a presentation of the key findings from the report, and then I hand over to Caleb. Thank you.
Awesome. Great. I'll do a quick intro, and maybe we can go through and do respective intros of the panelists and dive into some of these questions, but very excited to be here and thanks for having me. And thanks to the TechCabal team for this. So I'm Caleb, the CEO of a company called Tech Safari. We cover what's happening in tech in Africa. Slightly differently to TechCabal, we go into the stories behind tech and Africa's tech story. And yeah, really excited about building a global bridge between Africa and the rest of the world. So I'm keen to see this, and I think that work like this and reports like this are very important for us to understand where this ecosystem is at, and what we can learn and what we should be interested in next. Maybe I might hand over to Rosemond for a quick introduction.
Yes, thank you, Caleb and Walaji. Thank you very much. It's really awesome being here. My name is Rosemond Phil-Othihiwa. I am a corporate and commercial startup attorney. I find myself in the intersection between law and technology, pursuing and ensuring that companies and startups are regulatory compliant. I currently lead in my role as a senior legal counsel for Africa for ALX Africa as well, and I'm excited being here. Thank you.
Cool, and over to you, Matt.
Sure. Hey, Caleb and Rosemond. Matt Davis. I am the co-founder, co-CEO of Renew Capital. We're a Pan-Africa venture capital firm. From 2012 to 2022, we were a private equity firm focused only in Ethiopia, but now we're in 13 countries and are investing at the pre-seed and seed stage, tech-enabled businesses. Lots of very interesting activity happening this year, so excited to dive into it. Back to you, Kevin.
Fantastic. So are we good to just dive in, Mobolaji?
Yeah. Can you hear me? So I'm going to do a presentation of the report just before we start the conversation. My colleague was supposed to share the screen, but it seems she has network issues. So yeah, let's go straight into it. 2024 in Africa's tech ecosystem was interesting. When we look at the total amounts raised, $2.21 billion. Acquisitions, which saw a jump compared to 2023, we had 39 acquisitions. Expansions also grew rapidly, 38 acquisitions. The sad part was that the number of tech workers were laid off again in 2024. Of course, it's much lower than 2023 and 2022 when there was like a bear market. Fintech, as usual, got the most funding. across sectors, while housing startups got the least. Debt deals increased this year in terms of counts, but in terms of value, it dropped compared to last year in 2022. And in terms of mega deals are deals that are worth say $100 million and above. We saw 5 starting from moves, 110 or $100 million raised. We also saw Time Bank and Money Points, which both of them became unicorns after their Series C and Series D raises, respectively. And then we talk about funding. I think in the last couple of years, say 2-3 years, there's been a lot of talk around funding, say a drop in funding, or we're seeing the reversal to the mean. And here I think about insights, looking at the data from 2019 to 2024, we believe it's likely that there's going to be a reversal to the mean as opposed to dwindling fortunes regards to funding. So 2021 and 2022 were peak periods and outliers in terms of funding when you look at the charts here. And then also by quarter, we break down the funding by quarter in 2024. We see Q3 and Q4 having strong performances, and primarily is driven by the 4 mega rounds that we witnessed in that period of time. And so the next slide is very interesting because most times when we talk about funding, there's always this talk about the big 4, Nigeria, South Africa, Egypt, and Kenya. This year, a number of them saw a reduction in funding, like the big 4 saw a drop in funding, and it was drastic for some countries. I think it was minimal for Nigeria. But it's also interesting that we are seeing the rise of funding in some other markets. We could call them tier 2 markets like Ghana, Tanzania, Uganda, Tunisia, Cote d'Ivoire, and even Mali, where there was a bit of political instability, where they saw major or high percentage increase in funding compared to 2023. And in terms of acquisitions, we also saw a jump in acquisitions compared to last year. But the jury is still out. Do acquisitions mean survivals for startups? That's from our conversations with investors and experts. Or is it exit options for investors and also for founders? I'm glad that the experts on the panel today will be able to discuss that with us. So the next slide is expansions. Expansions they really grew in 2024, and it's primarily driven by the fact that, for instance, key markets like Nigeria and Egypt were roughly in high inflation. And then startups are just trying to, one, diversify their revenue offerings by going into different markets, and also trying to expand the pie instead of staying in one key location. So what happens is most startups build their expertise or gain traction from one location and then try to move to other locations to gain market share and increase revenue. And then regulations, I think I don't think it's any new story again that regulatory activities have been on the rise in the past 2 years, and it's primarily because government officials across the continent are beginning to see that the virtual and physical worlds are intersecting. So there's a rise of AI regulations because I'm sure almost everyone on the call has used ChatGPT or Cloud or any of these new AI tools. And it's also important that Africa is not left at the back door in terms of AI and then the future of work. And also cryptocurrency. I know previous 2-3 years, there was a bit of negative reactions towards cryptocurrency. But what we've seen in 2024 is that a lot of countries are beginning to give cryptocurrency the green light. And you would also see one of the things that we also learned from speaking to the expert was that crypto companies or crypto startup founders need to work with regulators to try and make them understand that this piece of technology also has great use cases compared to the previous years where it was used for illicit activities. And also for fintechs, we saw that in Nigeria, for instance, there's an enforcement in compliance checks for startups, digital lending. We also tracked that in Q1, digital lending in Uganda and Kenya. There's been a spate of predatory lending across this market. And so next slide, we move to 2025. What does the future look like in terms of regulations, funding, expansions, and acquisitions? So for regulations, we are likely to see more regulations in 2025. A lot of countries are getting concerned with new and emerging technologies, cryptocurrency, AI, and even fintechs. There's a push to strengthen regulations around the industry. And then with funding, just as I mentioned in the charts previously, there's a regression to the mean. Although some Africa-focused funds have reserved amount of funding, and then we'll see a bit of deal activity. With a focus on sustainability, business models have to be sustainable and there should be clear paths to profitability. I think one interesting thing that we noticed in the Q1 report was the fact that there was a shift in mentality from growth at all cost models to profitability. And we saw the likes of time banks who attain profitability for the first time in 2024. We also saw Jumia try to cut down operation losses. And we expect to see more of this even with early stage startups and late stage startups in 2025. And then as a result of these, expansions will likely increase. Like people are trying to optimize for revenue. There's a growing digital adoption, regulations across markets. And for acquisitions, again, just as I mentioned, like while speaking to experts, the vast majority of acquisitions, mergers and acquisitions may not necessarily be exit. So we've seen an example is a strategic partnership between Wasoko and Max AB. Also in Nigeria, we saw an acquisition by a consortium of investors of a business banking startup, Brass, by Piggyvest Ventures platform. We expect to see more of this and not necessarily exits as the time is. So that's what 2025 looks like for the tech ecosystem. So how can founders and stakeholders prepare for this? I think with regulations, the major thing we have to do, the major thing that has to be done is the big tent approach, collaborating with regulators, making them understand what's happening in their sectors. And then with funding, just a focus on profitability. How long will it take my startup to attain profitability in the next 2-3 years? What are things I need to do? And then for expansions, companies or startups shouldn't expand for expansion's sake. It has to be that there's a clear opportunity in this new markets that they are going to, and then the building blocks or the digital infrastructure for adoption of digital tools for startups or digital products that startups are building is available here. So pretty much that's what we are. That's how we're thinking of 2025 year at TechCabal Insights. Thank you, everyone, and over to you, Caleb.
Yeah, fantastic. Thanks so much, Mobalaji. There was so many insights in there, so many trends. I'm very keen to pick them apart with this expert panel here. Maybe before we talk about 2025 and what we're expecting, why don't we look back to last year? I'd love to hear, maybe starting with you, Matt. What were some of the trends or things that you saw in 2024 which you found interesting and that kind of dominated the themes that you saw that year? That may have been covered in this report, or maybe things that you've noticed were not included in that report that you saw from the investing side.
Yeah, no, I think 2024 for us is very interesting. I think towards the end of the year, it got really, really interesting. I mean, I'm from the US, so most of what we've seen, even in the past couple of weeks, when it comes to policy, and with the Trump administration coming in, it was a lot of kind of like figuring out how that's going to impact the global dynamics, our investor pool. But what was really interesting, and I've been seeing this more and more in our pipeline, is kind of the exuberance around AI, seeing that kind of surge in and into the pipeline. And now it's not kind of like we're an AI company, but it's now becoming a bit more ubiquitous and becoming almost a tool that if you don't have it, you're not probably moving in the right direction. And so, it's been interesting to unpack that. Definitely seeing more maturity in our pipeline with our founders. I was pleased to see some of the valuations starting to come from the stratospheric kind of unrealistic, naive expectations from founders down a little bit more to reality. Still seeing a lot of naivety around that in some cases, but in the more mature markets like in Egypt, here in Morocco, where I'm calling in from, you're starting to see founders like really be able to come into the market and raise capital. And you see it. You see the founders that kind of have done their homework, and they're serious because they're not just putting a number out that's so unrealistic, or that was what I got back in 21 or 22, and now I have to do more than that. Like coming in and saying, yeah, that was unrealistic, I'm doing a down round. All of our shareholders realized that was unrealistic. Really, we really believe in this product, though we want to see it grow, but we need capital to do that. That maturing. So it's like kind of going from the freshman year to more like the junior year. It's just like, oh crap, we actually have to really do well and start to study if we're going to want to get a real career once we graduate from here. And I think that's what I kind of felt across the board, across multiple countries. Still, certain countries are better than others. But yeah, I would say that that's this slight maturing of the ecosystem was what I experienced.
Very cool. I think there's a lot in there. I'm very curious to pick your brain a bit more soon on the AI side, and how you guys think about that in portfolio, both of you. But yeah, let's go over to Rosemond. What did you see last year? Like, what were some of the things that you noticed in our tech ecosystem, in startups that you were working with?
Yeah, of course. Just even double clicking on what Matt has said, it was quite an interesting year, especially like the last of the latter part. I mean, overall performance, I would say that it was more or less like a stabilizing year. Although you would say funding sort of declined, at least compared to year on year, right? Of course, the number of layoffs and shutdowns reduced. And you could see that there's some form of resilience and adaptation happening across board. Key events that actually happened beyond just the unicorns emerging and big merger and acquisition deals, you realize that the ecosystem is like, as we said, is shifting now from just high growth, high burn models to sustainable and structured scaling, right? And I think that that's incredibly important, because when you look at how things had happened from 2021 to 2022, call my opinions a bit weird, but I would say that it was not, and it was more or less a correction from an anomaly, right? And 2024 was that year where, although it looks like funding slowed down, you could actually see some stability. And so players within the ecosystem now realize that it's not just about bumping up figures and numbers, but actually putting sustainable models and a long-term view and oversight in terms of how you decide to build, launch, and scale, right? There was also a lot of interesting AI regulation activities, as you have different countries coming up with different AI regulations, the African Union, Nigeria coming up with different policy documents, and across other countries. So I feel that we are still in progress, but there's a lot of waking up that has happened. You have to be in it for the long game. And I think that that mindset has been clear across board, especially with the funding trends, as you have seen, which I know we'll still dig deeper into. But yeah, those are just some short thoughts from me.
Very cool. Yeah, I definitely agree with that idea of like maturing, growing up is definitely a theme, you know. I think one of the things I've noticed as well, I have a small fund, so I invest in startups, and I feel like 2 years ago, it was a lot of, hey, I have a cool idea, I'm going to go raise money, and this is a bit of a lifestyle. Everyone can raise money, you have a pitch deck, you worked at like, you know, any of the big tech companies, and you can go make it happen. Now I think a lot of those founders have sobered up and like, hey, this is going to be a lot harder and like much more of a stretch. So I think that it is cool to see that funding actually taper off, but not like fall off a cliff as well. That was one of the things that I thought was quite good about last year. And yeah, I guess from here, I'm curious to know a bit about how you're thinking about regulation. That's something that you brought up, you know, AI policy, other policies. Like, what do you think about that rise of regulation in some of these sectors like AI and crypto? And where do you think that's going to take us in this coming year across the continent, but also maybe even globally? Like, we're seeing so much activity with crypto in the US being regulated. So I'm curious about how you guys are thinking about that.
Yeah, I would like to say, you know, of course, we did see a rise in regulatory activities across sectors. And sometimes the question that would now be on the hearts of stakeholders is, what are the short and long-term implications, right? Questions like, would it increase barrier of entry or hamper innovation? And here are some of my thoughts. In terms of short-term implications, one of the things you realize that there will be higher compliance costs. You're going to have new startups facing increasing licensing and reporting requirements. So of course, there's going to be some sort of increase in the bar being raised for entry. And I mean, I stand to be corrected, but there also could be some level of uncertainty that could cause some VCs to pause crypto bets until there are clear frameworks within those ecosystems, particularly in countries where their crypto and their AI regulations are still nascent. And so you basically see that that's something that was also, then of course, stronger consumer protections. You realize that there's been a lot of clampdowns, regulatory clampdowns. So things like unethical AI use, predatory lending are things that are going to be, you know, harped down on more intentionally, because as I speak, there are already policy frameworks now that are currently passing stages of reading across different senatorial and of course legal legislative forums, just trying to ensure that there's enough adequate protection on that, and even to the global landscape, lots of policies are coming in now, and then there's a lot of conjecture. So different entities or different countries are going to be looking for ways to ensure that there's some sort of protection. We have the African Union policy document that has been done, and different countries are also doing that as well. Just to add, and finally, long-term implications for me, and I think this is the most interesting part for me, is more strategic startups. Companies at this point will have to wake up and realize that they have to integrate compliance by design, avoiding later stage regulatory crisis. And I think that's something that startups or founders who are going to be building in this space have to now pay attention to. It's no longer a need or nice to have. It's now a must have to have compliance by design embedded within your startup or company framework. So those are some of the things that I think are quite relevant when it comes to AI and its regulation, and how I begin to see things happening contextually as we go further.
It's a really interesting point, Rosemond. I especially that last bit of like thinking about compliance first and being strategic about how you think about regulation here. One of the things that we wanted to double click on here is like, will that actually increase or like or lower the barrier to entry to growth? And like my initial reaction to that is, if a startup at pre-seed or seed stage is thinking very deeply about regulation, they could wait for a long time before they even start doing anything. And there's kind of this thing where, at least in this side in Kenya, it's a sense of just do it, but do it like in a small way until it gets big enough. And then once you're big enough, okay, now think about regulation. Now go hire the head of policy or whatever at your company. How do you think about that? As this field gets more regulated, is it actually going to support startups, or is it going to make it harder to even get started?
I think it's going to be a double-edged sword, in my opinion, because depending on the sector, especially sectors that are very sensitive, like fintech and crypto, you cannot say you are going to leave regulation for a later time. So what you're going to have to do is that you're going to work with what you call like the minimum compliance step to be able to at least get something in the market that has the backing of the regulators on board. So if that means that possibly your product that will be released or launched is not ready, or maybe you do not have the capacity to be able to comply at the moment, you definitely have to look for that which you can comply with. So it's gonna raise a barrier quite a bit. But I think that founders who are smart would begin to start laying the basic groundwork required so that they do not end up getting stuck at the point where regulators now come with clampdowns. That's why I said compliance by design. So as you're thinking, you are integrating compliance systems and processes internally without even the need to possibly maybe hire, right? Members of your team have to have an understanding of the regulatory environment so that even when they are designing products, they're already having those compliance requirements at the back of their mind so that they don't end up, causing problems for themselves, maybe in future or something, until they are ready.
Awesome. So cool. Matt, do you have a take on that question before we go into the general regulation question?
No, Rosemond, very good answer. I enjoy hearing you speak, and this is your field much better than mine. The only thing I would add is more on the practical advice side. As an early stage investor, I think one thing that founders can do to hedge the risks of regulatory changes and getting stuck in a sandbox, for example, which I've seen a lot of companies like go to die in a sandbox and never get their bank approvals, is getting the right person or early stage investors on your cap table and having them, if they're well connected and they can bring you to those regulators and they can learn about, or they can back channel and make sure that the regulators know the name of your company. They know what you do. They know that, because I was with a very prominent investor in Nigeria a couple months ago, and he was saying that, he had invested in a company, and he was sitting for lunch with a big regulator, and they had just shut this company down, just like literally just turned them off. And it was simply because the regulator didn't know who they were. And he didn't, and so their default reaction was click, shut it off. And he's like, wait a second. And then he played the role of explaining what they did, who they were, because the Nigerian regulators said, well, I don't know them. Right. And so you can kind of like interpret that in a creepy way, like, that doesn't sound like above board. But literally, sometimes it is. It's so, I think we underestimate, especially founders underestimate even when they're pitching to us investors, they think that everybody gets what they do. They think that everybody understands the technology behind their product. And they even speak in that language. Unfortunately, when you do, you don't often raise money. But if you're able to communicate to investors and tell them in simple terms what you do, and then keep doing that in a proactive way into the market, all the way up to these regulators, they'll start to understand you. And you can be not only impactful for your own business, but you can help the entire ecosystem by upskilling. Because these regulators, to be honest, they don't know. Like half of them don't know what the heck's going on, even really skilled people. So that's just one thought there. I think the midterm, I would encourage, I'm actually quite encouraged. And again, I'm from the US, so I realize that it might look like we're a total mess right now. But I've been very encouraged by what I have seen the administration do around regulation. And I don't know if you just saw at the AI Summit in Europe, Vice President Vance gave a speech where I mean, it wasn't great, but it was essentially, he was saying like, look, deregulate this stuff. Like we cannot have, you know, and he was talking to Europe and mostly that group. But I think that message, that's good, right? We don't want, as investors, as the private sector, we don't want to be burdened by just regulatory mess that is going to slow us down. We understand it's there to protect the consumer, but sometimes it gets way overdone. And I'm excited about what I'm hearing from the administration, because these things have ripple effects through the entire globe. So I'm hopeful that we're going to see a lowering of regulation around crypto, around fintechs, around AI. I think we're going to benefit from that in the coming years.
Yeah, fantastic. Really cool in that regulation piece. Maybe we move over to the idea of like funding and funding amounts, right? We've seen that this is year two of year two coming down the roller coaster. We've been consecutively coming down. And one of the things actually you mentioned, Rosemond, and was in that presentation, was about reverting to the means. I'd really love to ask, like, tell us a bit more about that idea. Like, what is the mean, and like, what have we experienced maybe a few years ago, 5 years ago till now? And what are we coming back into? And what can we expect now in terms of like the types of rounds that we're seeing and the types of startups that are going to get funded in this next sort of era of tech in Africa?
Yeah, it's quite interesting because I mean the numbers speak for themselves. As at least this year, we had a total of about 2.2 billion. That number was like like a minus 25% year-on-year drop, and it's so funny that the total number of funding that was raised, basically, you realize that it was quite interesting, because at the end of the day, when you compare to 2021, even down, it was definitely lower. And one of the things that you realize that the second half of 2024 performed better than the first half of 2024, and of course the second half of 2023. The first half of 2024 was about 80%, and the second was about 25%. And some of the things that you realize is that this is simply because, like I mentioned earlier, there was a stabilization. 2021, you had about 4.3 billion, 2022, 4.6, 2023, it was like everything just crashed to the ground. And like I said, there's a stability going on that we can clearly see. But one of the things you realize in terms of even the companies or the startups that got this funding starts were late stage startups, they fared better, right? Even early stage funding still sort of more or less remained a little bit weak. And of course, signaling a more cautious investment climate. Current levels right now are closer to our historical growth trend. And then you also realize that even macroeconomic factors, so global interest rates, like something that Matt mentioned, VC risk appetites, would basically determine future funding levels. And I think this narrative of funding winter, I think for me, I could be wrong, is outdated. We are entering a new normal, right? Where investors now are prioritizing profitability over growth. So it just, or just, there's something about, responsible growth at that. So some of these numbers are really just reflective of the current ecosystem, and with the countries, some of the countries that did best, of course, you say the big four, and if you look at the report that was earlier shared, we had some other countries beyond just the big four coming up. If I recall, when I saw the stat, I know Nigeria did about $410 million at that rate. Kenya was about $638 million. Egypt, South Africa. Then, of course, countries like Morocco, Benin, Ghana, they really came up, and that was a really good one. But I think Matt has a bias. Maybe he's going to respond, because I know he mentioned that earlier. He has a bias for East Africa, right? Because East Africa definitely, representing Kenya, basically came. The volume was like 33%, and Nigeria was just a little bit lower than that. But then again, realize that different ecosystems and funding climates are maturing as well. But you can see that stability happening all round. My only part, and I think I have a duty to also say this, it was not a very good year for women-founded companies. In fact, there was such a huge, when you look at the gender lens, I mean, it was a bit depressing, to be honest. We didn't have as much traction as we possibly, and we are hoping that that's going to be better. But I know possibly Matt will have something to say about that. Another thing that I would say is, of course, in terms of the year, about 9 unicorns claimed almost a quarter of all the fundings being raised, with I think a total combined value, when you look at every trajectory, about 2.5 billion or so. So there's still much more happening, and I feel that it's too early to make conclusions. But then again, you realize that investors now, like you have Renew Capital, you have Techstars, Digital Africa, Catalyst Fund coming up. So I think something I would just add also is in terms of the sectors that received some of these funding rounds. Of course, we have fintech, of course, representing, but climate tech this time, I think represented about 32% of this funding raised in 2024. And you could see also that there were some exits that also happened also in that sector. And that's interesting to see. That gives you some sort of lens as regards where the minds and the eyes of investors are looking at, in terms of how they intend to, and where they intend to put their capital. So these are just some of the few things that we've seen. But I mean, for me, I would just say that there's still that growth, there's still that maturity. We are nowhere near where we need to be, but there's just a stability in terms of the funding that are coming in. And then there are particular sectors that we know will continuously always have an eye of private equity players and venture players. And it's a matter of now prioritizing, like I said, sustainability over just numbers, figures, or traction. So I think that's something that's quite interesting. And, I feel that this is still going to keep happening. Different mergers, acquisitions, and exits are still going to keep happening, but we are definitely looking forward to seeing that there is going to be an increase, particularly on the female side of funding. I'm not biased, but I'm just being truthful that we need to have an equal representation in the way we invest primarily in different sectors and in different areas. See guys who are doing great stuff and believe in them well enough to be able to back them up, because there is really, really great stuff happening. Yeah, I'll just stop there. Maybe Matt can add some more detail to it. Thank you.
Awesome. Yeah, go ahead, Matt.
So sorry, the question you're asking about, like what the trends are? Or?
Yeah, I mean, like we just talked now about this idea of, the funding coming down. I think that's
okay.
Take here on like this being the new normal, not a funding winter. Do you agree with that? And like how are you seeing maybe the future of funding and like funding amounts on the continent?
Yeah, I think this is just macro trends. I mean, if you look at Africa's trend, it parallels the global trends. I mean, I don't think this is it's a global funding winter, because it was 21, 22 was ridiculously stupid. I mean, we pumped so much capital with zero and even in some countries negative rates. Any idiot with a bank account was going out and becoming a venture capitalist. I mean, it was just like, it was out of control, because you can't put it in your bank account and make anything, so they're hunting for yield. All of a sudden, as those rates go up, and you have your bank accounts now making more money than your deals in frontier markets or in venture capital, you're going to pull it all back and put it there again. So I mean, I think it's just macro. trends. And I don't think what's pathetic is that Africa gets 1%, right? That's ridiculous. I mean, that's what we should all be looking at is how much are we getting, not is it going up or down. That's just going to happen. I mean, that's just the world. That's macroeconomics 101. What you should be saying is, why aren't we going from 1% to 2%? Why aren't we going up to 25%? Because 25% of the world's population is going to be on from the continent by 2030. How is it possible that there's such a big gap? I think that's the piece that we should all be saying, why is that happening? That's annoying. That's stupid. What can we be doing better? And what you should be doing is saying, hey, government, stop jacking around with the currencies so much. Get our economies under control. Eliminate every barrier possible for starting or shutting down a company so entrepreneurs aren't spending mind-numbing amounts of time trying to do what this economy needs most, which is grow companies, and get the heck out of my way. I think that and manage your own currencies better could be the best thing that can happen for the continent overall. So up or down, all that stuff doesn't matter. 1%'s a joke. And that's the thing that we all should be saying, we need to be doing better. And right now it's entrepreneurs. Yeah, you got to be getting to sustainability. Stop playing around like you think this, raising capital is the job. No, creating an amazing product that's solving a really hard problem. Africa has tons of problems. It's the greatest place in the world to start a startup. And then put pressure on your governments to start acting like grown-ups and taking care of you, not squeezing you for everything you have. If you want my real opinion.
That's great. Two people saying they met for president. So yes, that was fantastic. I love that take. I thought just one interesting tidbit is like, making it easier to start companies and shut them down. In Ethiopia, I think you spent a lot of time there. Like Ethiopia, it's notoriously difficult to close down a company to the point that entrepreneurs don't want to start one, which is crazy as an idea, right? So I think making these like barriers for starting and ending is really important. I want to double click on one thing that both of you brought up, which is almost like counterintuitive to this idea of more funding. And that's this idea of like being sustainable, right? Like we talk a lot about growth and about needing big companies. There's this article in The Economist that came out recently about like needing larger companies, not these small survival-esque businesses, which I agree with. Like big companies drive countries forward, but what about this strategy now of like every founder really looking at this idea of like bootstrapping or being sustainable or like unit economics? Like this is not actually quite in line with this idea of high risk, high reward growth. And yet a lot of founders and companies are forced to do that. Massive companies like MoneyPoint, forced to like look at profitability or being close to that to even raise money. So like, how do you pair the two? Can we actually have these massive companies that are focused on sustainable growth, or are we looking more at like do well, have good unit economics, maybe get acquired, but not at this like very large like venture scale outcome level?
Yeah, I mean, I think this question as an investor, well, first off, just to give very practical advice, everyone that's on this call and any founder that I meet, if there's one thing that you could learn and master that will save your life as a company and put you so far ahead of others that are trying to raise and just starting companies and building companies is your cash flow. And to learn, there's a very simple tool. I'm pretty sure on YouTube somewhere is a video of us, and we have a tool available for founders. It's called a 13-week cash flow. And literally, if you just worked on that every Monday, you have a call with your accountant or you do it yourself. I mean, I have one for my family. I have one for my business for a multi-million-dollar company. I still look at it every week. So step one is like where I see companies go really wrong is the founders take their eye off of their cash flow. And it's just such an easy tool to forecast, hey, am I going to be okay for the next quarter? Like, am I going to have enough for payroll? Am I collecting from my customers? Are they paying me? if you get that down, right, that's step one. Like, get a grip of your cash flow. And then two, if you get, even at the pre-seed and seed stage, if you get your unit economics like correct, just as you were talking about, Caleb, if you get your unit economics right, and you can kind of nerd out on your numbers for just a little bit, and you're improving your gross margin. And then you get super scrappy, you eat ramen, you sell your car, you live in your, your parents' basement or your buddy's apartment, and you bring your cost way down and you get to sustainability. Then when you come meet me or any investor, and you're now pitching for growth, not for survival. And that is a very different game. That is a very different conversation. And that's a very different you that's talking to me. Now I want to invest in you. I'm like, oh, really? Because you don't need me. I can actually literally feel that over a phone. I can feel that when we're in a meeting together. I can feel when you got your, you know what, together, and you need capital because you see an opportunity, you're going to go after it, versus I know when you're weak. I know when you're a wounded animal on the side of a road. I can smell it. That I'm not going to invest in. Nobody will. Nobody will touch you. So your job as a founder is to get a grip of your cash flow, take your burn way down, get to where you don't need money. Only the money that you need is to grow. We'll all feel it, and you'll raise capital faster than anybody else out there. That's my best advice to anybody ever. Get to a point where you don't need me, and that's when you're going to be able to raise from me. I mean, it's just like basic stuff.
I love that idea of like tight unit economics, understanding your growth engine and being like, okay, cool, we can do this without you. And we're coming from a position of just scale. I wonder though, like after that, then what? After they raise, does that mean we go back into like, hey, scale the crap out of this thing? Like double down, like increase your, like your cost of acquisition, or like, do you recommend that companies then like after you raise money, do you go for moonshots, or are you seeing more companies actually stay sustainable? Because I think that question, like after raising that capital, is the difference between these, like, I think very like larger bets versus like steadily growing companies, which are still good, but this isn't necessarily like venture scale. It's not like exponential, or like it's not as quickly exponential.
I think that depends on the business and the industry they're in and where they're positioned in what country, for example, what market they're actually operating in. So I don't think there's like a standard answer for that. The answer is yes. I want both. I want you to both scale like that, and I want you to be sustainable. But what I really want is I want intelligent decision making. That, like, when you blow your wad of capital on a bunch of flights and hotel rooms to new market expansion without you doing your homework, without you running the country's investment policy through GPT and figuring out if you can even operate there, without you calling me up and telling me, hey, I'm going to that country and I know you have a team member there, can they set me up with a bunch of meetings so I don't go there, waste a bunch of money at the Holiday Inn and blow all of my, I've literally seen companies do this. Or the other problem is they jump around and go to all these conferences because they think it's cool to be on stage and talk like that. That's what pisses me off. That's where, when I see that the growth, that when you actually peel back the layers of the onions on, yeah, we burned through our money because you were pushing us to growth. I'm like, well, show me how you spent it. Show me your go-to-market. And did you actually execute on your go-to-market, or did you just make bad decisions? That's what I mean by, like, I think the maturing is happening, because I saw a lot of dumb stuff in like 22, 23. And like all those people have failed now. And now the people that are left, they kind of they pinched their pennies. They were smart about their growth. And now they are hitting that kind of inflection point where you're seeing exponential growth. But like, as Buffett always says, the people that are the wealthiest, their income goes like that, but their cost of living stays flat. That's beautiful. Like, those are the wealthy. Like, that's, Buffett still drives the same beat up piece of crap car he drove for years, because he knows the temptation. The minute you see 150,000, 200,000, $1 million in your bank account, you're going to do dumb stuff. I see founders doing it. They've never seen that capital before. And they abandon their go-to-market. like keep those costs down. And I think a good shareholder, a good investor will be right on your shoulder, whispering in your ear, make a smart decision. I think that's again, it's not a yes or no one way or the other.
Yeah.
It's smart decision making. Sorry, go ahead, Rosemond.
Yeah, I gotcha. Rosemond, I'd love
I
your take
actually
on
raised my hand by mistake, but I think it was in time. Just to add, I think Matt has said everything. The only thing I would just want to just add is the purpose for the raise in itself. Is it a game of trying to get a higher valuation so that you can attract more investors, to get a higher valuation to attract more investors, or you are thinking about the operational dynamics of the minimum things you need to be able to be sustainable? I think that's the question to ask, especially when you are making either scaling or operational decisions internally as a company. So that's a major thing to look about and actually be critical about, because at the end of the day, you do not just want to have over bloated figures or a very expansive cap table, and we are not seeing traction, we are not seeing the results, or we are not seeing the solutions that the company itself is meant to solve, right? And I understand Matt's frustration, because we like the shiny effect syndrome. It's really, really nice to have. But at the end of the day, the companies that reach the finish line are companies that stay stuck to the business vision, the key vision of the company. And then if they're going to scale, they do that intelligently, not just because resources or capital is available. And that's something that we all have to actually understand as founders. Yeah, I'll just state that there.
Yeah, awesome. And then I guess just one more question on this idea of profitability. If this was 2022, how would your advice be different? You know, or 2021 when it was peak funding, would you have the same perspective? Or would you be encouraging your portfolio or tech companies to be operating differently?
Well, that's a very interesting question, because 2022 was a very interesting year. The excitement of that year was, oh my goodness, if I have an idea and I have this, I can get as much funding as I want and I can go straight to the moon, right? Those are some of the things you would call outlier events. My advice would be, and it has always been, ensuring that you have enough support structures and systems to guarantee sustainability. My advice has never changed. Maybe as an investor or as a founder, maybe that would have been different. But because I sit in regulation and I see risks all the time, in fact, 80% of my work means that I have to look at the risk of, no matter how beautiful the idea or the project or the startup or the company is, we can see risks, we can smell them from a mile away. So the goal and the advice has always been sustainability, has always been compliance, has always been having internal corporate governance systems in place, always, regardless of whether there's a funding winter or there's a funding summer. That advice has always been the same for me, especially from a regulatory point of view, because regulators don't want to know how much you are raising. They want to know that you are keeping in compliance with the laws that govern your business activities in their jurisdiction. They don't really care about your cap table. They just want to see compliance. So mine has always been ensure that you are playing by the books, you are playing by ear. And if you have the ideas as regards scaling, ensure you are doing that within the bandwidth of the law. I'm sure we all know lots of companies now that are being clamped down as a result of internal operational dynamics and corporate governance failures. That's a major thing that has been highlighted. So my advice would basically be, compliance. I think that's what it will be. Whether you're in 2021 or 2024, it has never changed and it never will. Fortunately or unfortunately, depending on how you see it.
Unreal. Thanks, Rosemond. Matt, I'd love your perspective. Like if this was a few years ago when cash was flush, would you be giving the same advice? And to everyone tuning in, we're going to open up to questions next. So if you have any questions, put them in the chat and we'll go through them.
Yeah, I mean, I think it's a good question. I would see it more as strategy. So like the way that we like to partner with our founders is more like they already are very, if we screen them right, they're already very smart. And how they run the back of the kitchen and how they change the menu in the front of the house, they obviously have to be responsive, right? I mean, if matcha is suddenly the drink to have and everybody else has it on the street and you don't, yeah, you're going to miss that market opportunity. Get matcha. That doesn't mean that you have to like run out and blow out and change everything in the back of the house. You still have to run that like an absolute machine. So like the discipline around, again, go to market, how you spend your budget. 21, 22, yeah, the markets were flush with capital. There was exuberance. But if you like the advice I would give is, yeah, when the sun shines, go out there and raise as much capital as you can, but you better put it in a high yield account, lock down those accounting controls. You make sure that you bring that budget to us. Don't go making stupid decisions. And hopefully, if we picked a good founder, we don't have to lecture them on that because they already know, like, this is my war chest, and now I'm going to crush it. But I'm gonna burn down that in a very strategic way. That's that back of the house discipline. I think that's what I mean. It's like at the end of the day, whether funding is hot or not, whether the interest rates global are down and the markets are flush with capital or not, that the best of the best, they still have that Buffett discipline where they're like, yeah, I'm going to of course go out and buy right now, or I'm going to sit back because the prices are too high. I mean, it all comes down to that like intellectual discipline. So I don't think I would have to give them any advice. They would go out and get money, put it in a war chest, but still be executing the back of the house like a machine.
Okay. Yeah, cool. Nice. Great takes, Matt. Awesome. Hey, let's go to questions. I'd love to see what people want to know about here. You can drop your question in the Q&A chat or Q&A box. And let me just see if there's any here already.
Yeah, there's one on the venture debt. I think that's definitely that question.
Who would like to take that? Where is the venture debt question?
The venture debt question. What's our take on venture debt? I think.
Yeah. Yep. What are your takes on venture debt? Do you issue any of it, Matt? Like, do you ever do that?
I mean, we're doing some, but only with really, again, extremely disciplined founders that have already created a product and they're exploring an embedded finance feature into their SaaS product. So I think you have to be very careful with it. I think you have to, again, back to cash flow, really understand your unit economics and your cash flow and be able to service that because it's debt. And even though it's like putting venture in front of it makes it less risky for you as a founder, no, don't think that for a minute. So you really have to be, yes, it's non-dilutive. And one thing I think founders, which I'm starting to see, again, a lot more maturity is their, I'm seeing founders walk away from, smart founders walk away from bad deals. I think what we saw in 21 and 22 is a lot of stupid money and a lot of founders raising. And now as the tide kind of pulls out and they're standing holding, safe notes with liquidity preferences and convertible notes with like all of these horrible terms that they didn't really read through or understand at the time. And, everybody's starting to clamp down on them. I think venture debt has the risk of kind of creating also kind of it's a new product that so few people really are familiar with right now. And I mean, I see the ecosystem now just starting to get comfortable with safe notes, but now there's the side letter, right? And people are racking their heads around, what's now in the side letter. And so, convertible notes are dead, safe notes are hot, but now we've got side letters, and then you start tacking on venture debt to that. We're going to see it again. So I get worried a little bit with folks unless they really have a lawyer. They're going to charge you. You can put it through GPT, but you got to be really careful if you can really read through and understand that. So I would wade into it with a lot of caution. I would make sure that your company is really kicking off EBITDA before you do it because you're going to have to pay it, and treat it like that.
Nice. Rosemond, would love to hear your take, but maybe just in 1 minute, you can explain what venture debt is for the folks here who aren't familiar with it.
Yeah, of course. So, one thing is like Mara said, it's non-dilutive, and basically it's kind of like a financing option, right? Designed for growth stage startups that have already raised venture capital sometimes. It usually comes in forms of maybe loans, credit lines, revenue-based financing. And the goal of venture debt really is just to supplement, not necessarily replace venture capital. So think of it as a sustainability plan that makes sense when you are actually you're capable of actually like returning or replacing loans, or there's a credit line given to you, or there's some sort of revenue-based financing that is given to you to just supplement your venture capital, which would actually be dilutive, right? Yeah, so that would just be a short, very simple. I don't want to go into the technicalities of it, but just a short one-liner as regards what venture debt possibly is. Yeah.
Awesome. And did you have a perspective on that question? Like, what's your take on venture debt? Are you seeing it common, like more frequently, less frequently? Like, where do you think it's going?
Well, we actually have now, like there's more or less like a, what's the word? There's a sandwich about it. There's the aspect of the capital and there's the aspect of the debt. For me, I would just say there's a time when venture debt makes sense and when it doesn't. Some of those things will basically be more or less startups that have predictable revenue streams. Very good for venture debt. Startups that want to possibly maybe extend runway between equity rounds. They could possibly also do that as well. I think another thing I have seen in practice, especially when it comes to dealing or having conversations in investment committees where they are trying to consider venture debt, is usually more or less asset heavy models. So there's a lot of need for capital intensive, especially capital intensive sectors. Really, those are some of the three circumstances where you definitely love to have venture debt. You don't want to have venture debt when you actually have not mapped out a plan or a strategy as regards how your runway is going to be and how that debt is going. Because at the end of the day, it will end up crippling your business if you do not have a sustainability plan, or you do not have an internal team that is able to, like what Matt said, do the crazy work at the back lines, right? So that's something that I have seen happen for usually more mature startups. Yeah. Really at that stage, at that point.
Yeah, fantastic. Awesome. Hey, so anyone tuning in, any other questions you have, just put them in the chat. Oh, we have some in the Q&A, I see. Okay. Brilliant. So do you think credit fund in Africa is a good idea? I guess that means debt. I think we're talking about debt here. Any additions to maybe the two perspectives you had before, Matt and Rosemond, on venture debt?
I mean, any capital that we can get into the ecosystem now, I think is going to be good. I want to caution founders to really make sure they know what they're doing. Don't just take money, because all money is different and all investors are different, and you should know them. They should know you. You should really make sure that you understand their agreements, read the detail. There are some tools that are free and available online that you can kind of run a term sheet through, but the term sheet's still so high level. But you can really ask for the subdocs, ask for the agreements, ahead of time. But yeah, I think, it's a $300 billion funding gap across the continent. I mean, this is just crazy. We have to get really creative about it. So I do think embedded finance is a huge opportunity, and funds that are starting to look at that, I think, are going to really do well. We're looking at that. I think it's extremely exciting. But again, I want founders to be really ready and understand what they're taking on.
When you say embedded finance, Matt, do you mean like companies that maybe have some sort of like software offering or some products that they attach funding to, like
Yep.
lending to generally? Yeah.
Exactly. I love that space. Yeah.
And are you just seeing lending, or are you also seeing other like fintech products like insurance, or like, is it just lending, or?
It's just lending when the way I'm viewing it, but I do see more companies starting to get into. I mean, they're still kind of early days, like essentially digital brokers for more mature insurance companies, but insurtech, there is the options and opportunities. You have to be, again, really careful because you're managing people's capital. But yeah, there's such a liquidity crunch. You can kind of boil it up from the millions and billions of people on the continent, or you can attract it and deploy it smartly into the ecosystem. But one way or the other, I think, yeah, embedded finance, and because at some point, almost every B2B company is going to realize that their customers are capital constrained, and it's going to slow their growth. And so then they're going to have to become a financier of their own growth, right? And that's where I think there's the potential and the risk of embedded finance to be really good. As an investor, what we're going to be looking for is, okay, how strong is the data? How good is their model? right? How good is the team that's kind of evaluating the credit that they're gonna give to their customers? So on that second bounce, like how robust and fulsome is their data stack?
Mhm.
But yeah, I think that there's huge opportunities. I think we're going to see a big wave of that coming forward. So
Yeah, fantastic. Any additions, Rosemond, or should we move to the next?
Yeah, I think one or two things. When I got the question was, do we need or are we able to have those credit funds? And yes, it's a very great idea, but let's also understand that macroeconomically, there are lots of dynamics because some constraints can happen where you have funding gaps, and then you really have to now consider whether the banks are even playing a role. And because they are not, you're going to, like just like what Matt said, see a different way by which finance and capital is raised. But you must understand what works for you because, like I said, there's different kinds of money, and you need to know exactly what you need to do and when you need to have it. So most of the time, you have to do your due diligence in research, understanding the pros and cons of these investment deals, regardless of any way they come, whether they come in terms of debt, they come in terms of credit unions, or they come in terms of credit loans. You just have to be careful to know what kind of fund works for you, because not all kinds of funds are good for you, especially depending on the nature of your sector. So it's important to do research, get consultants, get specialists to really do a deep dive and give you quality information that you can get to make those kinds of decisions, whether you need to accept those credit funds or not, right? So it's very important to also look at your local context, especially if you are doing business in a localized environment, because many of the times your ability to churn out business and to be profitable is also affected by the capital you raise and how you use that capital and how you pay back that capital and how you raise that capital. So all these things are embedded. So you need to put and factor all those things together when making those kinds of decisions, whether it's good for you or not.
Yeah, awesome. Thanks, Rose. That's great. Fantastic. Let's go to another question. So we have one from Gwyn, which is about traceability and market access, the impact of climate change and the opportunities offered by a carbon economy, take compliance, record keeping to ground level communities. Traceability data streams are increasing. How can I engage with the team to explore the opportunities? Let's maybe take that as like, are you doing any work like that at the moment? Maybe Matt, or Rosemond?
So based on the fact that she mentioned on compliance, I think I can't give you specific bespoke advice, right? But I can tell you, at least there are some certain things that you need to look out for. And let me see if I can churn out about 3. The first thing is you need to, first of all, just identify the strategic alignment with your organization. If you and your team are trying to explore opportunities on those kinds of matters, assess how maybe issues like traceability and maybe compliance, exist within the compliance legal frameworks that exist, in your own space. Then when you start talking about carbon economy opportunities and how they integrate, first of all, there needs to actually be a map out of what your data streams and compliance needs are. So you engage with your products, your compliance and your sustainability to identify basically ways where you can get that data, assess the data in your current repository and see if you are able to actually get that. And there has to be cross-functional conversations, roundtable discussions, internal workshops will always work when you're trying to engage with stakeholders that are particularly interested in that space, because whether you like it or not, with the increase of funding in climate investment tech and things like that, issues like credit verification, ESG, impact tracking are going to be conversations that you cannot avoid, especially if you are playing in that space. So sometimes you also even need to assess your technology needs for integrating traceability into your business process. So like I said at the beginning, compliance by design, right? That's supposed to just be the work by which you do if you're going to do that. So I would just say, as you keep doing that, ensure you do your proper research, look at the organizations and look at what they look out for. And then by the time you start implementing this internally, ensure you use the adequate data. Maybe you have to develop a business case, and then leverage external partnerships, having those conversations on that, and possibly you'll be able to make a headway. I do not have enough context as regards your specific company operations, but from a general perspective, these are usually things that you can do to ensure that, when you are trying to get those partnerships or you are trying to get those traceability data streams, you can engage with different things to explore opportunities.
Awesome. Matt, do you have any perspectives on that?
I'm not sure I understand the question exactly the same, and maybe I'm reading it wrong. I looked at this and think more about blockchain and how we're looking at blockchain and using that to strengthen traceability in a number of sectors that are high potential for Africa. So minerals and again, carbon all the way to coffee in Ethiopia. There's just tons of opportunity as that technology matures and you start to get the applications there. So I read it totally different, and I probably I'm way off base with that, but that's where my brain went. So
Awesome.
nothing more.
Cool. Yeah, we might move on to the next one. I like this question from Richard, which is, yeah, a lot of activity in the fintech sector, but edtech didn't have it so well. Which underserved sectors would you rank as promising in terms of innovation, regulatory, and raising capital?
Yeah, so I mean, the data clearly states that, climate tech represented 2%, and then of course, fintech always. Underserved sectors are like retail, healthcare, very important, healthcare, agriculture, logistics, and transport. Those are sectors that whether they become the big ones, they would always be needed. We all know the basic needs of human life: food, clothing, and shelter. If you are playing in that space, regardless of how funding may come into that sector, you realize that that's a space that will constantly always be in need. You need to innovate around it. You possibly are going to need to, iterate and do some deep dives as regards how more uniquely you can solve problems in that sector to get the kind of funding or to get the kind of backing you need as a founder in that space. But issues like healthcare, logistics and transport, agriculture, even deep tech that looks like it's really, really big now. You realize that so much money has really not come as much as we have seen, but it will definitely come. So those are sectors you should keep a bird's eye view on. If you're playing in that space, I think you're in a good place. All you need to do is just get your operations, your systems right, and also get your practices right as well. And then I believe funding will come. Don't be moved by the big figures. Oh, fintech got this higher number, climate tech. No, there are sectors that also have very relevant spaces. And for me, my eyes has always been on retail, logistics, health, right? Those are very critical aspects that you should also think about. And you just need to find the investor that works for you, that also is paying attention to that space. It's not just about the big micro, large figures. Those are areas that will also become very, very unique. Not even become, they are already making a lot of value beyond just fintech and climate tech. So look at that too.
Awesome. Matt, what do you think? What sectors are you looking at?
100% no, what Rosemond said was spot on. I think, obviously we're not stupid. We have to raise money and we're just like everybody else. And then we go where the opportunity is. So I still think that we have a long way to go to tap out on fintech. And I think that that's a great market. I'm very bullish on that. And again, I think every company, at least B2B companies, is going to, with embedded finance, essentially kind of become a fintech company in the future. So I think that too won't be a vertical, but almost be like with AI an enabler. But with that, yeah, I think, I've struggled, man. I've tried to, we've looked at health tech, we've looked at ed tech and ag tech, and they're kind of like the redheaded stepchildren. And I feel bad about it because every time a deal, and we have bi-weekly deal calls that go for hours, and and it's just like every time one of those comes up, everyone's just like, oh, like we want to do something there, we really do, but it's just like traction and performance, and there's a lot of copy paste. Like we've got a pharmaceutical logistics company, and now we're doing inventory management. It's just like, you just kind of see the same things. There's not a lot of, I guess what I'm saying is I would love for somebody to actually come forward with something that's not just like everybody else. I think that's what is pissing me off about those deals and why we all roll our eyes, because I'm not seeing a lot of innovation yet come out of there. And so maybe I'll throw it back to the ecosystem and say, you give me a good deal that's really different, like 10x different than all the other things that I see, and I will take a meeting with you. But if you're just another one of those companies and you tell me you have no competition, which then you just didn't do your homework, I'm gonna be really pissed off. So sorry, I don't mean to be a jerk about it, but somebody's got to tell, because the donors, they pump so much money into this stuff too. And you see like all these propped up companies that are not real. And, I just saw you guys wrote TechCabal wrote an article that said $100 million of grant funding is now, gone for the Kenya ecosystem. Good. I mean, sorry, but it sucks. I mean, a couple of my companies have been impacted, which but still, I mean, like, come on, stop. Like the hard, raw, real companies that have a real solution, those are going to be the ones that'll come forward in that space. So I'm hopeful, but I haven't seen anything.
That's so interesting. Such an interesting take, and I totally agree. Like, I think one of the benefits of being an angel or having a much smaller fund is we get to wait. Like, we don't have any time pressure to invest. We only did one deal last year, and it was a very unique ag tech deal that was you might have seen it. It was a spray that like made agriculture like last twice as long.
Fresh.
Yeah. And
You
that
did
was
Got Fresh.
like,
Okay.
I don't love ag tech. Like I've never seen, like, it's massive, but I haven't understood it. But I was like, that is genuinely unique. What we're doing right now is actually a sports team in Kenya. So it's just like
You're doing that
these
deal?
are actually like unique deals where it's like this could 10x, it's very different, and it's not the cookie cutter like payments or like pharmaceutical logistics supply chain thing. So totally with that, I think like I'm kind of sector agnostic, but it's just more like what is the interesting opportunity that makes a lot of sense.
Yeah.
Cool. Yeah.
Cool.
Maybe. Sorry, did you guys want to add more to that?
No, I'm good. I'm good.
Okay. Let's do one more, and then I think we can throw it back to the TechCabal team.
I see a question from Salim. Yeah.
Okay. Impression, presence, and answers first. Nice. How enforceable are investment agreements and exit clauses in Africa for companies without Delaware C Corp? And what should angels and early stage investors do to protect their interests? Good question.
That's such a brilliant question. I've had a lot of people say, I'll try my best to answer this very quickly, but I have so much to say on this. I've had a lot of people say that what a lot of founders have done, especially those that are really not in touch with their stuff and their market, is that they just copy and paste Delaware-based LLCs or C Corps and try to implement that in Nigeria. You have a challenge in Africa. Africa has a very unique context, especially in the growth of our own legal regulation. Before Delaware got to where it was, there was an intentional process to intentionally make deal sourcing, venture funding really easy for founders at a whim. Trying to do what has taken them hundreds of years to do within, I say, a period of 10, 20 years is going to give some challenges. And I'll mention three. Number one, enforcing investment agreements in Africa is very challenging, especially because of legal system variability. You have issues as regards regulatory uncertainty, like we talked about, and enforceability of exit clauses, right? So, okay, I'll give a typical example, and I can use Nigeria for context. There's a particular section of our Companies and Allied Matters Act that basically says that you cannot sell or issue shares at a discount. Now, when you look at that particular section and you're trying to do an investment agreement that says that you can offer shares at a discount, which actually is a safe note, how do you go around that? Right? And so one of the things, or one of the ways I have seen a lot of domestic founders within the continent do, is that they then go and register a company in Delaware so that they can be in compliance with those laws. And there are several ways you go about it. And a lot of founders do not even know that these issues actually exist. So they go out there, get a template, and they do not understand their legal and regulatory framework. And that's a major frustration, especially if you are doing fundraising in the continent. So what can angel and early investors do? Number one, jurisdiction selection and offshore structuring is important, especially when you are doing business and you already having scale at the back of your mind. You need to understand that for the first 1-2 years, fine, play low, but by the time you start thinking about bringing international investors on your cap table, on your board, you have to start thinking strategically as regards the structure of your company in itself. So investor-friendly jurisdictions will always be very great, at least until some other jurisdictions are able to jump the boat. Then robust shareholder and investment agreements. Things like drag along, tag along, right, with specific dispute resolution mechanisms that are not too heavy when it comes to implementation costs or regulatory issues. You need to have that. Even using convertible instruments have to be done with accuracy and in recognition of the unique landscape of the startup where the business is being done. I see a lot of mistakes happen where there's a lot of copy and paste. And at the end of the day, when it comes to enforcement, because one country A will say, before you can repatriate capital, you need to get a certificate for capital importation, and you need to have this, and you need to have that, and then you have to go back again, and the startup has to go and be in compliance, and there's a lot of delays, and their exits are taking longer and taking longer. So this is what I advise in just 3 sentences. Number one, you need to, whatever startup you're going to be investing with, the due diligence has to go beyond who is the founder, what's their CV, how long have they been in business, who is on their board, what's the traction. No, look at their compliance regulation as well, because if they are compliant, it helps you to understand, okay, now we can put in money there, because we know if it's time to get the money out, we are not going to struggle a lot. They've done everything they need to do. They have the documents that are required based on their own sector or their own place of doing business, and it makes it easy for you to exit. So those are the questions. I would always say begin with the end in mind. That always is very important, especially as an investor, more importantly as an angel investor, and even as a founder, because you cannot at the end of the day escape if you do not have those regulations in place. I think that's just basically it for me. I don't know if Matt would definitely have something to add or something. Yeah. But those are my thoughts, really.
Yeah,
But
fantastic.
that was great. That was great. Yeah, no, I don't.
Nothing to add? Okay, cool. Hey, TechCabal team, how are we doing? We might throw it back to you. I think that there's a round out to do from here.
Yeah, thank you, Caleb. Really enjoyed the session and how you moderated it. A lot of insights from Matt and from Rosemond. I think any founder and investor here, the session must have gotten free advice from both of them. Thank you everyone for joining today's session. Thank you to our speakers. Thank you to everyone. I saw there was a lot of activity in the chat box. The report is now live. You can download it. My colleague Victoria dropped the link to get the reports. Yeah, I wanted to be sure. Yes, she's dropped the reports there. We also wanted to share that we've been tracking the key figures around acquisitions, expansions, layoffs, shutdowns, and it's a product in a beta stage. So there's my colleague is going to drop a link in the chat box to join a wait list for that. So when it becomes publicly available in the coming weeks or months, that's something that I would like to share, and then get feedback from people on how to use it, or how they're going to benefit from the products. Thank you everyone for joining. Again, this event was produced by TechCabal Insights. You can download the reports on our webpage as shown already in the chat box. Yeah, pretty much that's it. Thank you everyone for joining once again. See you on WhatsApp, see you in LinkedIn, see you everywhere. Please download the reports. If there are any interesting insights you get from the reports, share them on social media. You can tag us. And if you have any opportunity to do like a breakdown of the reports on your social media page, video, text, just do that and tag TechCabal Insights. Thank you. Thank you once again.
One quick one before we go. I just want to say, I didn't say it, but I should have. Matt and Rosemond, thank you so much. Your insights are incredibly valuable, very, very intelligent, and like deep in the ecosystem. Would love to connect after this, and thank you for such a great conversation, and thanks to TechCabal for making this possible.
Thank you so much.
Yeah, thank you guys. Thank you all so much. Good luck this year. It's going to be a good one.
It will. It will. Fingers crossed.
It will be. 2025 will be a good year. I think everybody should know that. All right, bye. Cheers.
Thanks, guys. Bye.
Bye-bye.